So yeah, so I guess we can kind of start. So this is module 7, growth through acquisitions. And this was kind of a Thomas's passion project. So to say, he saw this really amazing lecture online by, I believe it was from the Wharton School of Business and the Scale School. And there was a lecturer who talked about how can companies grow through these mergers and acquisitions. And he compelled me to create a slide deck out of it. But firstly, we have some updates. So we actually have quite a bit of activities planned for you this last semester. So we have CIBC Capital Markets virtual recruitment event. And you can, this slide deck will be sent out, but also the links will be sent through the email. And that'll be January 31st, 3 to 4 p.m. BMO Capital Markets virtual recruitment will be February, Women's in Finance, February 23rd. Breaking into investment banking. I think that's hosted by Breaking into Wall Street panel event, early March. And then we have our investor challenge, which is in late March. Yes. Yeah, and so the agenda today will have our main topic, growth through acquisitions, and then we have some kind of some case studies, and we have a more academic view of this, which is what I brought to the table. And so, yeah, growth through acquisition. So yeah, Professor Dave Wessels, this was his lecture, and this is almost kind of inspired by that. So there's two main ways for a company to grow, and one is via increasing sales and the general size of a company's operations over time. And that strategy is known often as organic or internal growth. And the other is by acquiring another company or a number of companies to pursue growth via some form of coalition, partnership, such as a joint venture, merger, or strategic alliance. And then finally, you have the full acquisition. So that's where you just buy out at the company straight outright for yourselves. And so we get to the point of driving value creation. Value creation is driven by this balance of growth, return on capital, cost of capital, and ability to sustain the performance over time. And here we have that organic revenue growth, a healthy return on capital, sustainability of performance, and ability to manage risk. And so a strategic view of M&A, the portfolio choice, shows that companies drive growth through 3 primary sources. And they have this 8.6% growth breakdown. So where portfolio momentum is accounting for 5%, some markets are growing and have natural momentum to them, and they're pivoting towards that growth. You have market share, which accounts for half a percent, which is the hardest to capture, especially in the Western market, where market share is not seen as the biggest priority of most companies. And mergers and acquisition, which account for 3%. And that's tricky if, like, let's say there's $100 million company that doesn't grow and it acquires another $100 million company that doesn't grow. Then what you're left with is just a $200 million company that doesn't grow. So making sure that momentum is there is still a top priority. And using acquisitions for the pivot. So companies should use acquisitions to pivot towards markets with growth momentum. To transition towards that new market, they have to understand the underlying customer trends, create innovative products and services, build skills and capabilities. And yeah, so I think this is pretty self-explanatory for itself. If say Amazon wants to kind of pivot into the well, they already have it. So let's just say this is like pre 2010, the web cloud computing, then they would acquire a cloud-based company, and so they can create Amazon Web Services. And a tactical view of M&A. So if the goal is to grow the business, it is critical to leverage both internal capability development as well as acquisition to provide new products and services for your existing customers, improve your quality and satisfaction so you're able to increase that price, duration, so make the customer stickier, which is just make them stay around longer, make the brand name a household name, and acquire new customers for your existing products. So from a tactical view, there will be a choice of internal development versus acquisition. And for a more strategic perspective, a portfolio will kind of think on both sides and try to find that equilibrium. So as some of you may have noticed, today is going to be talking more about like a buy side sort of thing. So like this is for all you people who want to get into private equity, venture capital, and even sales and trading could benefit from this. Yeah. And the capability transition. So as you evaluate adjacencies to your core business, consider your current capability set, as well as new capabilities required to meet the needs of your consumer set. And you have to leverage existing best-in-class capabilities, and this will give you that permission to compete. But you also have to be innovative and develop new capabilities that give you a chance to win. And so we come to the expectations of your acquisition versus the reality. So here are a list of reasons for M&A deals not transacting. So you have valuation gap, unreasonable seller, lack of capital. So you can kind of read through this and see how it's break down. But the next graph is the one I really want to show you. So for all of like the M&A that were promised or hopefully promised, so you can see a large chunk of them, like almost 40% are not transacted. So you might think, oh, 64%, that's still pretty good numbers, you know, we're crossing more than half. But think about 4 out of 10 of all of your supposed transactions are not completed. That's pretty big. And so there's 8 kind of priorities you want to make work. So we'll get to that on the next slide. But how you make an acquisition work is insist on the innovative operating strategies and don't do the deal if you can't find a leader. So you need to know who is the leader of this company, who's running the show, you know, like it's not just some C-level executive at the top, just as a placeholder. Offer big incentives to the top level execs, link compensations to changes in cash flow, push the pace of change, foster dynamic relationships among owners, managers, and the board, and hire the best people that can do this job. And yeah, so we get to the priorities. So the research that's kind of what I'm talking about right now is done by kind of the Scale School at Wharton, which has found that successful corporate and financial buyers often use these 8 operating principles. And these principles affect almost every stage of the acquisition process, from identification of candidates to the post-merger management. And yeah, so we'll kind of go through them one by one. Well, I won't give them all. So the first priority is market opportunity validation. And the first question in a growth-oriented deal is whether the growth opportunity is real and the combined entities can realistically capture all that growth. And so market analysis use primary, you have your primary and secondary research that can identify potential opportunities by the product, customer segment, market size, or region. And this analysis typically covers the specific solutions that target offers and how they map into the acquirer's portfolio, so the buyer's portfolio. And the strength of the target's competition and how well the combined company can penetrate into the markets going forward. This disciplined approach to analysis and prioritization forms the foundation for success of the other priority areas, helping to ensure that all the planning efforts are centered on the highest value opportunities. And then we have priority 2, the go-to market strategy. So with specific market opportunities identified, then your next step is to determine how must these areas be attacked. So a coherent go-to-market strategy is critical to achieving the growth objectives of the deal, maintaining that business continuity and deploying the right talent and resources of both companies in the most efficient and kind of effective way. So this is kind of just your attack plan. So priority 3, so setting revenue targets. So I think, yeah, it's been said that obsessive focus on the business case is key to M&A success. And the one thing to actualize like all this focus to establish all these strategies and plans is to just set a specific revenue and margin goals for the deal and assign accountability for them to the right business leaders. So can we hit these like kind of black and white marks? And priority 4, so portfolio rationalization. So determination of which products and services the combined company will take to the market is driven by a market opportunity validation conducted at the outset of the deal exploration. Specific consideration should also be given to short versus long-term opportunities. And so in the short term, steps might be taken to quickly create new product bundles or solutions. So this is like your quick hit. You have product improvements courtesy like of technology brought in by the acquired business or pipeline. And they might help highlight specific in-process opportunities to leverage the value proposition of the combined entities. And your long-term opportunities, you're just kind of, you may not have these quick hits, but you are thinking in 5 years, in 10 years, what will there still be a market for this? Will there still be that market opportunity validation for this? And the next in the series is the sales and channels execution. And these are critical execution decisions around how sale resources should be deployed and how external channels and partners can be best used to support them. And again, it's important to start with the identified market opportunities and confirm go-to-market strategy. So that's your priority 2. But customer segmentation is the thread that kind of ties everything together. Yet every company has slightly different ways of segmenting their customers. So therefore, when conducting a merger, it's essential to understand which target segments are most important across the combined companies, and then decide how to dedicate and redeploy sales forces to match highest priority clients. And the ones most likely to succeed are if they are deployed in the right market segment with the right sales quotas and incentives. And 6, so brand strategy refinement. Yeah, branding is everything. Branding must be considered at a corporate level, the product level, at the service level. And so every single level, it must be considered. And it's one of the first visible indicators of a combined company's direction and sends strong signals to both customers and its respective employees. Despite this, brand decisions are often rushed or made for political and emotional reasons. So it's very crucial to make the right strategic decision for the overall health of the merger. And then seventh, customer service model. In the best of cases, an M&A can be an opportunity to improve the customer service of the merged company. And creating a broad customer service strategy can be vital to retaining customers post-transaction and preventing the deal from negatively affecting service. Achieving these goals, however, can be difficult as the combined companies may have a widely varying service strategies and capabilities. And you also have to cut out some of the overlapping or redundant footprints or capabilities, or even maybe have to these two companies have different outsourcing models. So a lot of effort is required to understand the market position of both companies compared with their competitors, especially in the servicing capabilities and their performance. And customer service is especially important in some industries and deals, especially those who are consumer facing. And in those cases, should be a focal point of implementation planning. And finally, eighth, this is just defining the customer experience. So the quality of the customer touch points with the combined companies can be impacted by even the slightest changes of products, sales, or service strategies. And understanding these changes, what they mean to the customers, can make the difference between a strong customer retention and a major uptick. So the example I have for this is kind of the Twinkies. I think they around 2010, 2012, they changed their formula, and then it was just never the same. Like before, they were a household staple, and now we barely see them in 24-hour convenience stores. And so it isn't unusual for a company pursuing a merger acquisition to express high hopes that the deal will be a growth engine. So they're relying on this. The intention, quite reasonably, is that the resulting combination of products, peoples, and these pipelines will take these businesses to all new heights. And then that's when reality sets in. The combined businesses has to deal with the presence in multiple markets, a larger and more diverse customer base, a more complex product and service portfolio, and a high level of people and operational complexity. So cost synergies, a very tangible and often quickly attainable goal, take precedence over the grinding work of formulating and isolating and tracking revenue metrics and growth efforts. These cost reduction goals can even conflict with some of your revenue growth opportunities. So it's little wonder then that a mass majority of M&A deals intended specifically to enable growth fail to achieve their express growth objective. While M&A can be this hard road to grow from, the decision to make the deal is only the first of many decisions that will affect its outcome. And what can be an acquisition-oriented businesses? What do acquisition-oriented businesses do, especially those pursuing transactions with a strategic growth as a goal to increase their chances of successes? They leverage smart planning to forge solid growth. So M&A transactions almost always offer viable opportunities to achieve these cost synergies and drive efficiency, but growth-oriented companies should not allow themselves to become trapped by almost a short-term focus and simply attempt to save their way to the deal success targets. And success in growth-oriented M&A hinges on taking a disciplined approach based on real understanding of the actions and initiatives required to drive short and long-term value by addressing the 8 priorities outlined here. And both early in the deal process and throughout the integration, companies can emerge as high performers that capture the expected value of their growth opportunities. So now we have, I think, 2 cases for you. One is Blackstone and Hilton, and one is the Loblaw one, acquiring a Shoppers Drug Mart. And so we'll kind of look at this case first. So in 2007, Blackstone, Blackstone, as some of you probably know, this private equity giant acquired Hilton worldwide in an all-cash LBO deal worth $26 billion, of which $20.5 billion was financed through debt, and $5.6 billion was financed through equity. And Blackstone sold the remaining stake in the company in 2018 for profits close to $14 billion. So that's almost 3 times its initial return. So how did they make $14 billion in profit? A leverage buyout. So after a third-party consecutive profitable year for the hospitality industry, Hilton Hotel became an appealing investment prospect for PE investors. And an expanding business transcending borders and rising profit margins called for strong partnerships with established firms in the real estate sector in order to fund Hilton's aggressive growth strategy. So Blackstone decided to make a large acquisition under leverage for primarily 3 reasons. 1, the use of leverage debt enhances expected returns on investment in terms of high ROE or IRR, and bank debt in a low cost of capital when interest rates are low in comparisons to equity, and debt financing is liable to tax shield effects. And Blackstone's thesis was to pursue organic growth, capitalize on the market opportunities in Europe and China, launch with new brands to capture more customers, and additionally, the firm pursued a high-margin franchising strategy. We built an incredible culture, a team aligned around a purpose and a cause to do great things together. And under Blackstone, a number of hotel rooms in the Hilton system almost doubled to 900,000. And the LBO became one of the biggest and largest debt finance acquisitions in the world. And despite huge risks associated with debt funding, the deal was well structured and many instruments were employed to hedge risk. And Blackstone's success with Hilton can almost be attributed to clever financial engineering, to free cash flow, and strong execution with Hilton's vast expansion. So you can kind of look at the history here. And so as just a recap, so LBOs is so one company's acquisition of another company using a significant amount of debt. So that's your leverage to meet the cost of acquisition. And the purposes of LBO is to help these companies make acquisitions without committing a lot of their own capital. And private equity players use this method to acquire companies all the time, build the companies again, and then sell them at a profit. There are sides of LBOs that can be quite ruthless and shark-like. I know there was this one private equity company buying newspaper companies or news companies, but they just basically didn't have this growth mind, or they didn't even have a growth mindset. They just poured on the debt on top of the company and just said, oh, this is yours to handle, which essentially just crushed the newspaper companies. And this is done either through just mismanagement, I think in this case with the P and news company, it was done out of like revenge or vengeance. I think they wrote something bad about them one time. They just wanted to destroy and kill the company outright. Yeah. But when done properly, it can be an amazing investment. So yeah. Okay. And then we have our second case. Loblaws acquires Shoppers Drug Mart. Finally, a Canadian example, right? We don't just want to limit ourselves to the US markets. So in 2013, Loblaw, a popular grocery chain, announced that it would acquire Shoppers Drug Mart for $12.4 billion. Don't ask me if it's Canadian or American, because I'm not sure. Loblaws was able to gain a top of the line retail pharmacy and company, and shoppers gain access to Loblaws' various food products. And the process, so Loblaws acquired all outstanding common shares in Shoppers Drug Mart and gained 1,200 drugstores in Canada. The transaction was financed through cash and equity in Loblaws. So Loblaws was able to reach a wider market, with many shoppers being in more urban and dense areas, and gained access to all of Shoppers' health products. And Shoppers still operates as a separate company. However, as they mentioned, they both have access to each other's products. So it's a mutually beneficial investment. And shoppers were able to expand fresh food availability, servicing a lot more people. And yeah, and so we kind of get into the academic side of things. So thus far, what I felt I talked about in the last 30 minutes, it's a lot of conventional wisdom that investment banks, company executives, and investors use when evaluating whether or not a potential merger will be successful or not. There's not much academic thinking behind it. It's just, even with the priorities talked beforehand, let me just scroll up to the priority. Okay, yeah, it's too far. It's too far ahead, but it's very HRE, if I would say. We want to, the brand level, we got to improve customer retention, all of that. And, it's not very innovative, I would say. But however, while it may be tempting to only consider what industry professionals have to say, we all also want to know, especially in finance, we know how often professionals make mistakes that can often be costly. So for example, the 2008 Great Recession was caused by banks trading convoluted debt instruments back and forth, making insane profits for the time with each trade, and simply pretending like the risks associated with credit, like the CDS, credit default swaps, and MBS as mortgage-backed securities, simply just didn't exist. So therefore, while finance professionals definitely have some subject expertise, we should also occasionally take the opportunity to look at the real world evidence from the past to not only empirically evaluate whether the conventional wisdom holds up to reality or not. So luckily for us, we don't need to find our own data or conduct our own analysis. Empirical analysis of stock returns upon mergers and acquisitions have already been done by academics. We can simply read their papers and compare their findings against what conventional wisdom would suggest. So while we only take a brief survey of the literature regarding mergers and acquisitions today, we also want to emphasize the usefulness of academic research in other areas of corporate finance as well. Empirical financial economics is a general look at real world data and uses advanced econometric techniques to identify interesting relationships between the variables that we can use to observe the world. So the literature can tell us whether a newly elected CEO will likely improve firm performance, whether a firm's capital structure is often given its characteristics, and whether construction of a firm's board of directors is conducive to maximizing shareholder returns, or instead its governance that benefits firm insiders more. So although there are by no means saying that you should completely disregard, the before stuff, the heuristic ideas of finance, almost the traditional way of looking at it, taking an empirical look at the data can often filter out any systematic biases that the market as a whole may hold. So today we'll review and summarize a paper in corporate finance that tries to evaluate outcomes of mergers and acquisitions and identify which factors are correlated with successful mergers and which ones are not. And this paper was authored by Marina Martianova, I'm not going to try that, Osting, and Luke Renburg. And the paper is titled The Long-Term Operating Performance of European Mergers and Acquisitions. And it was published in 2007 in the Journal of Quantitative Finance. So Martianova, Husting, and Renburg evaluated the success of mergers and acquisitions in Europe by comparing the after-merger performance of combined firms that against similar companies. In particular, they identify what they call peer firms, which are other companies uninvolved in a merger that operate in the same industry, are of the same size, and have similar past performances. And the authors compared these performance of non-merged firms against that of newly combined firms after the merger to determine the factors that are correlated with improvements in firm performance and when the two firms are combined. Specifically, the look at EBITDA, which we previously defined as earnings before interest, tax, depreciation, amortization, which is essentially a measure of the core firm's profitability. And this figure summarizes the techniques used by the authors of this paper. The authors first identify peer firms for the target and the acquirer, and see how EBITDA of these peer firms added together compare with pre-merger EBITDA of the target and acquirer firms combined, as if they were already merged. And they do this for 3 years prior to the acquisition. And they repeat this exercise for the 3 years after the merger to see how the difference in profitability changed. And by observing the differences in firm performance prior and after the merger, the authors can determine to the extent to which the merger led to an improvement in firm performance. And the main idea is that by comparing against peer firms in the same industry and of the same characteristics, the overall trends in market will be netted out in the differences. And so with the methodology explained, we can now summarize the main results of the paper. So first, the authors show that on average, mergers and acquisitions do not lead to improved profitability. This is in stark contrast to conventional wisdom. So normally we think that firms only merge together if there was some comparative advantage to take advantage of. However, this data only shows that 49% of the combined firms increased profitability relative to their peers. And the authors test a variety of hypotheses to see which factors lead to more profitable mergers and acquisitions. First, they show that it doesn't matter whether mergers are paid for via stock or cash. And there's often a lot of debate amongst bidder firms executives with respect to whether they should pay to acquire the target firm with cash, or if they should offer stock to the shareholders of the firm, or if most likely, if it should be a mix. However, the author shows that this debate doesn't really matter, as the resulting profitability of the combined firm does not depend on how this deal was made. So you can almost account for this parameter being insignificant. The authors also find that whether the merging firms are in the same industry or not. Also surprisingly, this has little to no effect on the outcomes. And this is in contrast to many public communications by firms who justify mergers as taking advantage of within industry advantages. The only two factors that are identified as significant is first, the relative size of the target firm and the cash holding of the acquirer. The data shows that acquiring both relatively small and relatively large firms is associated with worse performance, that acquiring a relatively moderate-sized target leads to better profitability. The authors attribute this result to large targets generating bureaucratic issues within the combined firms, and small targets not receiving as much attention, and therefore not improving in performance as a result. The most significant finding, however, is that acquiring firms with high cash flows tend to make the worst mergers. That is, firms with a lot of cash lying around tend to acquire firms that do not lead to improvements in overall profitability of either firms. So I think a lot of tech companies have just enormous amounts of cash laying around, and they're just basically throwing money at, startups and venture capitals to find startups. And they're basically just seeing whatever sticks. If we're losing, it's fine. It's just a tax write-off. And the most plausible explanation the authors in this article provide is that firms with a lot of cash flow often leads to managers wasting money, as I said before. And in other words, there is a moral hazard problem where managers of cash-rich firms tend to engage in what academics like to call empire building. So they're acquiring firms that have a lot of personal connections instead of those who would be more profitable to the firm. And this might also explain why acquiring smaller is not as profitable as acquiring medium-sized firms. So the result of these authors are interesting in the context of how M&A are usually talked about. And there are many interesting conclusions that we can draw from their research. But probably the most significant is that there are more to finance than what's reported on Bloomberg or traditional finance media. The authors often show that empirically looking at the data can lead to conclusions that differ from conventional wisdom. And in the context of M&As, however, this paper has told us that we should also be careful to think about the incentives of managers of bidding firms. For example, if we see a CEO trying to attempt a takeover that doesn't seem to have any clear benefits, it may be worthwhile to inspect the cash holdings of the acquiring firm to see if this may be a case of just empire building. So yeah, so I guess you guys can break off into your sector team meetings. Yeah, I apologize again for the Sunday meeting. It was just something that happened out of nowhere. But otherwise, if there is a sector meeting you guys plan, feel free to go. And if there isn't, enjoy your Sunday, and also happy Lunar New Year to the people who celebrate it. I'm feeling to you too.